Have you ever wanted to invest in the stock market but didn't know where to start? The stock market can seem overwhelming, but with the right strategies, beginners can build wealth over time. In 2025, smart investing is all about understanding key principles and leveraging available tools. Whether you have a small budget or are looking for long-term financial gains, these stock market hacks will help you maximize profits while minimizing risks. This guide will break down 10 essential strategies that every beginner should know. Ready to start your investment journey? Let us know in the comments. Don't forget to like and subscribe for more financial growth tips. Investing in the stock market requires patience, research, and a solid plan. Some methods involve short-term gains, while others focus on long-term growth. By following these proven strategies, you can build a profitable stock portfolio and achieve financial success. Let's dive in. The stock market rewards those who take the time to learn and apply the right techniques. With careful planning, even beginners can start seeing positive returns. Small, consistent investments over time can lead to significant financial growth. Learning from experienced investors and following sound strategies can help you navigate market uncertainties. Now, let's explore the essential hacks that will set you up for success. 1. Start with an index fund. Index funds are the easiest way for beginners to invest without worrying about picking individual stocks. These funds track major market indices like the S&P 500, offering diversification and lower risk. Since they include a broad range of companies, they provide steady growth over time. Many expert investors, including Warren Buffett, recommend index funds as a reliable long-term investment. They also have low management fees, meaning more of your money stays invested. Investing in index funds through a brokerage account or retirement plan, like a 401 or Roth IRA, can set you up for financial success. Reinvesting dividends further accelerates your portfolio's growth. Beginners should focus on funds with low expense ratios to maximize returns. Unlike active stock picking, index funds require minimal effort, making them a perfect passive investment. Over time, index funds consistently outperform most actively managed mutual funds, making them a smart choice for new investors. Staying committed to this strategy ensures steady financial growth. 2. Invest only what you can afford to lose. One of the biggest mistakes beginners make is investing money they can't afford to lose. The stock market can be unpredictable, and even the safest stocks carry some risk. Before you invest, make sure your emergency fund is in place to cover at least 3 to 6 months of expenses. Never use borrowed money or rely on investments for immediate expenses. Investing should be part of your long-term financial plan, not a quick way to make cash. Setting up automatic deposits ensures consistent contributions without overextending your budget. If a stock drops in value, having a safety net prevents panic selling and poor decision-making. Diversifying your investments helps spread risk and protect your capital. Understanding that market downturns are normal can help you stay calm during volatile periods. Investing should be a slow and steady process, not a high-stakes gamble. The key is patience. Building wealth takes time, and investing should be approached with a long-term mindset. 3. Learn the basics of fundamental analysis. Understanding fundamental analysis helps investors choose the right stocks based on a company's financial health. Key metrics like earnings per share, EPS, price to earnings, P/E ratio, and revenue growth indicate whether a stock is a good investment. Examining financial statements helps investors determine a company's profitability and stability. Comparing a stock's performance to industry benchmarks provides insights into its potential for growth. High debt levels can be a red flag, while companies with strong cash flow are often safer investments. Analyzing a company's leadership and business model can reveal long-term stability. Avoiding hype-driven stocks and focusing on solid financials helps reduce risk. Understanding industry trends helps investors make informed decisions about which sectors to invest in. Regularly reviewing your portfolio ensures that your investments align with your financial goals. Mastering fundamental analysis helps investors build a strong, profitable stock portfolio over time. 4. Diversify your portfolio. Diversification is key to reducing risk in the stock market. Spreading your investments across different sectors ensures that one bad investment doesn't ruin your portfolio. A well-diversified portfolio includes a mix of stocks, bonds, real estate, and other assets. Investing in international markets provides additional growth opportunities. Avoid putting all your money in a single stock, no matter how promising it seems. ETFs and mutual funds help beginners diversify without extensive research. Balancing between growth stocks and dividend stocks ensures steady returns. Rebalancing your portfolio periodically keeps it aligned with your financial goals. Learning to diversify early protects against unpredictable market downturns. 5. Follow a long-term strategy. Short-term trading can be tempting, but long-term investing consistently yields better results. Holding quality stocks for several years allows you to benefit from compound growth. Instead of chasing trends, focus on businesses with strong fundamentals. The market may fluctuate, but history shows that patience pays off. Even during downturns, holding on to investments rather than panic selling is crucial. Successful investors like Warren Buffett emphasize long-term value over quick gains. Set realistic expectations and understand that stock market growth is gradual. Avoid getting distracted by market noise and sensational headlines. A long-term approach ensures steady financial growth and less stress. 6. Reinvest your dividends. Dividends can be a powerful tool for growing wealth over time. Instead of cashing out, reinvesting dividends allows your investments to compound. Many brokerage accounts offer automatic dividend reinvestment plans, DRIPs. This strategy increases your shareholdings and enhances long-term returns. Dividend-paying stocks provide consistent income even during market downturns. Companies that consistently raise dividends indicate financial stability and strong management. Reinvesting dividends builds wealth without requiring additional capital. Over time, even small dividend payouts accumulate into significant gains. This strategy works best when combined with diversified, high-quality dividend stocks. Patience and consistency turn dividends into a powerful income stream. 7. Stay updated with market trends. Keeping up with economic news and stock market trends helps you make informed decisions. Understanding factors like interest rates, inflation, and global events impacts your investments. Follow reputable financial news sources and market analysts. Subscribe to investment newsletters or podcasts for insights. Learning from successful investors helps refine your strategy. Avoid reacting impulsively to daily stock market fluctuations. Instead, focus on long-term trends and sector growth. Knowledgeable investors recognize patterns and make better financial choices. A well-informed investor adapts strategies based on changing economic conditions. Staying updated gives you an edge in managing a successful portfolio. 8. Avoid emotional investing. Emotions often lead to poor investment decisions. Fear and greed can cause impulsive buying or selling at the wrong time. Develop a clear investment plan and stick to it. Setting predefined rules prevents emotional reactions during market volatility. Investing in the stock market may seem intimidating, but with the right strategies, anyone can succeed. Stay patient, keep learning, and trust the process. Which of these hacks do you find most useful? Let us know in the comments. Don't forget to like, subscribe, and share for more investing tips.